Before I begin to this video, let me give a quick disclaimer. I am not a financial advisor. The content of my videos represents my personal opinions and is provided for informational and entertainment purposes only. My information is not intended to be legal, financial, or an investment advice. Always conduct your own research and due diligence before making any financial decisions. Remember, it's your money. Please make informed decisions that are right for you. I'll never ask you for money, nor will I provide my phone number or personal email address. If you encounter any suspicious accounts or messages claiming to be me, please report them immediately as fake or scam accounts.
Welcome back to Talk Stocks with me, and a warm welcome to our new viewers. This is your weekly market digest where we focus on data-driven insights, cutting through the hype, fraud, and emotion that often cloud decision making. As always, we will recap the global market, review the NGX market internals, a new addition which is the S&P 500 market internals, and wrap up by highlighting short-term trading opportunities in the US market. Let's get started. Before we jump into reviewing last week's market performance, let's once again try to understand what is happening on the slide here. This slide shows you the market performance across key index or sectors or commodities across the world. As a data-driven investor or trader, you want to look for where the opportunities may lie, and that lie with the trend. Specifically, you want to position yourself, especially if you like to go long, where the trend is bullish, right? The trend can be bullish in the short term or in the mid term, or across both short term and mid term. So if you want to rank where the opportunities are more juicy, you want to look for opportunities where both the short term and the mid term are bullish. Now, if you want to have some trade-off, you can look for where the short term is neutral, but the weekly or the mid-term trend is bullish, or where the mid-term is bullish and the short term is neutral. But the best, the one that you really want to pay close attention to, is where you have the short term and the mid-term trends to be bullish. Now that is clear, the next logical question is, talk stocks with me. How do you arrive at a bullish conjecture or a bearish conjecture or a neutral stand or ratings? This is where my key comes into play. So what I typically do is I use the interaction of the close price, irrespective of the time frame. In this case, because we are looking at the short term and mid term, I'm looking at the interaction of the close price of the correct candle and the 20 exponential moving average, the plus DMI and the minus DMI, as well as the ADX value. And this is how it goes. I detect a bullish trend when the close price is above the 20 exponential moving average, the plus DMI is above the minus DMI in terms of values, and the ADX value is greater or equal to 20. Conversely, I detect a bearish trend when the close price is below the 20 exponential moving average, the minus DMI is greater than the plus DMI, and the ADX value is 20 and above. I give a neutral rating when I have neither a bullish nor bearish trend on the time frames. WTD stands for week to date, YTD stands to year to date. Now that this is clear, I'm not going to bore you by going through all those markets, but rather I'm going to save your time. You can pause the screen to have a look at the different markets on your own, but my goal is to zone in on where the opportunities lie going into this trading week. I'll start with the US small cap stocks that I quantify by the performance of the ETF VTWO. You could also use the IWM, but I prefer to use the VTW for my analytics. This is an ETF that is managed by Vanguard. So basically, once you invest in this, you are actually looking to benefit from the rally or the positive sentiment in the US small cap space. So this past week, this ETF delivered 1.55%. Year to date, VTWO has delivered 7.48% compared to last year's overall gain of 11.41. That's quite impressive. Within 2 months, it's more than half of what it did last year. In the short term, a neutral, slightly bullish trend can be identified, right? So the idea is that the trend is neutral, but I see bullish signal on that time frame, only that it is not yet a trend, meaning the close price is above the 20 EMA, but these other values here have not yet aligned, right? So that's why I'm calling it a slightly bullish trend, but in general it's neutral because it doesn't satisfy all these and conditions. It's an and some ors. So in general we'll name it or give it a neutral trend, but I see positive sentiments there. Also, from the weekly time frames, I'm able to identify a bullish trend. So this is one where the midterm trend is bullish, but the short term has not yet fully aligned with the midterm. Now, the next market that is showing positive sentiment is Canadian equities, which we track by the ETF VCN. Again, it's another ETF that is managed by Vanguard. So if you invest in this ETF, you are actually investing in the whole entire Canadian large cap market. This week, this ETF delivered 3.79%. Year to date, VCN has delivered 6.62%. In the short term, a bullish trend can be identified from the daily charts, and in the midterm, a bullish trend can be observed from the weekly charts. The Nigerian equities, which we evaluate by the NGX ASI, unfortunately, you cannot buy this index directly. You could actually buy the NGX 30, which is 30 of the biggest companies in Nigeria. But as a whole, this index delivered 6.95% this past week, and year to date, the ASI has delivered 25.30. The short-term trend on the daily chart is showing a strong bullish trend, and the midterm trend inferred from the weekly chart is also pointing to a strong bullish trend. We look at the commodity oil, which we track by the ETF USO. This week inked 6.21%. Year to date, oil has delivered 16.90% compared to negative 8.46% last year. In the short term, oil is displaying a bullish trend, which we can infer from the daily chart, while the midterm trend is neutral. So this is one of the ones you have to be careful with, right? Because the short term trend is bullish, but the midterm is still neutral, right? The midterm trend hasn't aligned with the short term trend. So you really have to be careful if you're trading oil. Gold is another commodity which we track by the ETF GLD. This past week delivered 1.93%. Year to date, GLD has done 18.25%. In the short term, a bullish trend can be identified analyzing the daily time frame, and in the midterm, a strong bullish trend can be identified studying the weekly charts. Silver is another commodity which we track by the ETF SLV. It's delivered 7.6% this week, and it's done 18.94% year to date. Silver experienced a slight correction the past few weeks. However, SLV is still displaying a bullish trend in the short term and in the midterm respectively. Welcome to this week's NGX Market Internals. The NGX Market Internals provides a data-driven look at the breadth and strength of the Nigerian stock market. Remember, the Nigerian stock market, which we track via the ASI, which is the All Share Index, comprises of 145 stocks and different sectors, right? These stocks range across different sectors such as industrials, oil and gas, banking, insurance, consumer goods, right? The purpose of the NGX Market Internals is to look under the hood of the market to see how efficient the engine of the market is running. Is it efficient or is it stinking? By using the market internals, we are able to identify three labels for the market. We identify the market as strong when there is broad participation across the different sectors, or neutral, where we have fair participation across the sectors, or weak, where we have narrow participation. And again, for every measurement framework, there has to be KPIs or scorecards that you keep track to arrive at the final rating. The market internals typically uses the moving average breadth as well as this Winston stage analysis to infer the strength of the market. The first measure we use, which falls under the moving average breadth, are the percentage of stocks that are trading above their 50-day moving average respectively. So what that means, when you list all the 145 stocks in the ASI, what percentage of them are trading above their 50-day moving average? Our data shows us that week over week, it remained flat at 81%, right? And 81% is a very good grade, so that's positive. We're also looking at the percentage of stocks that are trading above their 200-day moving average. We can see a very little drop, right, week over week. So you are seeing a negative 1 percentage point change. So this week we saw 85% of stocks trading above their 200-day moving average compared to 86% last week. Again, this is an A plus grade. The next measurement framework we use is the Winston stage analysis. And here we are looking at, from all these 145 stocks in the ASI, what percentage of them are in the advancing stage, right? So if you want to know more about the stages in any stock, feel free to look at Winston stage analysis. We are telling you that week over week, this remained flat at 81%, right? So that's why you have a 0 percentage point change. Again, 81% is an A plus grade, right? So we have three very positive scores so far. Lastly, we are looking at the percentage of stocks that are in a strong advancing stage. You can clearly see that the percentage of stocks in a strong advancing stage increased by 4 percentage points to 65% this past week, which is very impressive, right? So again, this is I would say a very good grade, right? 65%. It's not A, but it's very close to A, right? So looking at this, we can really say that the market is really firing efficiently on all cylinders. Again, we are grouping the different sectors into the stage based on Winston framework, and you can clearly see the NGX ASI is in a strong advancing phase. The NGX 30, which is a subsegment of the ASI, is also in a strong advancing phase. The consumer goods, the oil and gas, the industrials, the insurance, and the banking, these are the key sectors, right, that I track, all are in a strong advancing stage. So this is showing that the market is gaining or is benefiting from broad participation across the different sectors. We have no sector that is in distribution or in a declining phase. Once again, this is the market internals. It helps us to see beyond the glamour or the fanfare of the crowd. It helps us see how many stocks and sectors are participating in the rally. Do we have a lot or just a few? I pride myself with my ability to generate alpha from the market purely because I follow data. Looking to trade the US stock market this week, it's important that you follow a disciplined, data-driven approach to scouring for opportunities, whichever market you trade, whether it's the Nigerian market, the US market, the Australian market, or the Canadian market. One approach that I use and I follow judiciously is the forest to tree approach, right? So what that means is you want to identify the index where you trade, right? Is the index trending or is it trading sideways? Now, if it's trending, is it an uptrend or in a downtrend? There's a famous saying, a rising tide floats all boats. So if the tide isn't rising, man, you're fighting against the tide, right? So if the tide is floating up, then it's good to look for long positions. Now, if the tide is down, right, you want to look for short positions. So we're assuming in this case of the US market, right, if you remember from my previous slide where we went through the market summary, I labeled the US market and the large caps and the QQQ, which is technology, has neutral across both the short term and the mid term. So that means the tide isn't really rising, right? It's ranging. But doesn't mean you can't generate alpha, right? So one way you can generate alpha is by looking for long or short positions in a neutral market, right? The probability that you would make more money when the market is trending up and you look for long positions is higher than when you look for long positions in a market that is neutral. Similarly, a market that is trending down, you make more, the probability that you make more money is superior when you look for short positions versus looking for long positions. So the point is that the US large cap market is neutral, right? So as we're looking for long positions this week, you have to consider that and position size appropriately. So when the market is trending, perhaps you are going with a just speedballing here 100 unit sizing. In a case where the market is neutral, right, the probability is this is not really an A plus market, right? So you have to size accordingly. So you reduce your sizing. So now that that's clear, we are looking to go long in the US market this week. Well, I want you to know that you're better off looking for positions in a market that is trending, right? So in this case, it will be the Canadian market. But let's just pretend we are going with the US market. Now, one way I want to know what sectors are performing well, are showing strong short-term momentum versus the index. So my figure here is telling me the energy sector, the material sector, the industrial sector, utilities, real estate, and consumer staples are showing strong short-term momentum relative to the market. You see, you can't see technology, you can't see communication services, you can't see financials here, neither can you see consumer discretionary. So we are in a very defensive market cycle. Now, my figure has two shades of green. You have a light shade of green, which is the month-to-date performance, and the darker shade of green, which is the 3 months to date performance. Each of these are sector ETFs, right? So you can actually buy this ETF. The information on energy select ETF is telling you that if you held this ETF on the beginning of this month, you are up 9.54%. If you've held it from the last 3 months to date, you are up 21.17%. Now, the idea is if you know the sector that is showing strong short-term momentum, you can invest or trade it, right? You just don't go and buy it immediately. I mean, you want to also time your entry. And this is where technical analysis comes into play. You want to time your entry and apply appropriate risk management. So that's one way, identifying the hot sector, right, and participate with that in that sector. Another way is to look for the strongest stocks in the strong sectors, which I call hot stocks in hot sectors. In this case here, let's look at industrial sector. The industrial sector this month has delivered 7.27%, right? So if you own XLI, your position is up 7.27 this month. Now, I've gone further to look for the strongest stocks within the industrial sectors and look at them here, right? You can see, in fact, they have a adjusted score. This adjusted score is my custom scoring mechanism, right? This is how I'm able to rank scores based on their relative momentum, their strength versus the S&P 500, right? You can do this for every market you trade. If you are trading the Canadian market, identify the sectors, rank them. Which one are showing superior momentum versus the index in Canada, or the index in Australia, or the index in UK, wherever you are, rank them. Also rank the stocks within those sectors, so that if you know the strong sectors, you can look for the strong stocks in the strong sectors. So here I'm telling you that GNRC, and this is ranked in descending order, right? So GNRC has the highest score, DE, followed by FDX, HWM, ODFL, GSI, CAT, SWK, GV, Venova, GBTC, and you can see there what they delivered this month, right? You see GNRC has delivered 37% so far this month. DE has delivered 25% so far this month. FDX 20.7 this month. HWM 24, right? That's how this works. Now you know the strong sectors. Now you know the strong stocks within the hot sector. So you can also create this type of list for the energy sector, material sector, industrial sector, and so forth and so forth. Now when you have this list, this master list of hot stocks or hot stocks in hot sectors or hot sectors, you can now use technical analysis to time your entry and position size accordingly. If you follow this framework, I can guarantee you will have more winners than losers. This is how I am able to generate alpha in the market, and so far, so good. This is how you build discipline, structure to become a consistent, profitable trader. Now let's close this week's video. Globally, we're in a selective market environment, not a broad risk-on rally market. US large caps, Nasdaq, the ASX 200, which is the Australian large cap market, and world equities are largely neutral, which means this is not the time for aggressive blanket exposure. However, we are seeing clear leadership in the Canadian market, where we are seeing bullish short and mid-term trends, Nigerian market, gold, US small caps. The US small caps is particularly showing a bullish mid-term trend, right? Meanwhile, we're also seeing oil showing short-term strength, and Bitcoin is under pressure. The message is simple. This is a rotation market, not a momentum chasing market. Capital should be positioned where trends are aligned and reduced where structure is weak. At data vesting, we stay disciplined, we follow data, and we rotate with strength. Because we know in neutral markets, patience protects capital. And in bullish markets, conviction builds wealth. If you found this week's video helpful, please drop a like, hit the subscribe button, and I would like to see your market view in the comments. I'll see you next week. Stay safe and trade safe. Cheers.